Right, so welcome everyone to this new event of the webinar series organized by the E-Axis Forum on Climate Change, Macroeconomics and Finance. Thanks to the organizers. My name is Emanuele Campiglio. I'm an associate professor at the University of Bologna and I will be chairing this event. It is with great pleasure that I can introduce you to tonight's speaker, Dr. Josh Ryan Collins. Josh is currently head of finance and macroeconomics at IIPP, the UCL Institute for Innovation and Public Purpose. He was previously head of the finance program with the New Economics Foundation. His work has looked at finance and credit using many different angles, disciplines, and methodologies. Tonight, he will be presenting some of his current work linking finance and environmental sustainability in a context of radical uncertainty. So before leaving the floor to Josh, let me explain how this event will be structured. We will have to conclude the webinar at 6:45 p.m. Central European Time. Josh will now speak for about 25 minutes. Please feel free to pose any question you might have in the chat or in the Q&A window during his presentation. If these are immediate clarification questions, then I will briefly interrupt Josh so that he can explain. Instead, I will postpone the deeper questions to the Q&A section. At that point, I will give the audience the possibility to ask the questions that you posted in the chat directly to the speaker, or if you prefer, I can ask them on your behalf. So this is it from me. I will now leave the floor to Josh Ryan Collins. Thank you very much, Josh, for joining us.
Thank you, Emanuele, and thanks to everyone who has joined online today. I'm just going to try and share my screen with you now. Emanuele, please tell me if this is not working. How's that looking?
Yes, we see it.
Okay. How's that, all good?
Perfect.
Great, okay. So I'm going to be talking about what I call here environment-related financial risks. And by that, as Emanuele suggested, I mean both climate-related financial risks, which most of you, I'm no doubt, will be highly familiar with, but also broader non-climate, environment or nature-based financial risks, as has been recently the term that seems to be emerging to describe these as nature-related financial risks. Because I think it's really important we talk about both types of risk, and certainly the sort of key concept that I'm going to be proposing, this concept of a precautionary policy framework to dealing with these risks. The uncertainty that drives that approach applies both to climate and to nature risks. So I just move on. The work I'm going to talk about is based on two papers that I've published over the last year, co-authored with colleagues at University College London. I work at the Institute for Innovation and Public Purpose in London, directed by Mariano Mazzucato, which is very much a sort of policy-oriented department. But other colleagues involved in this research are Hugues Chenet, who is a senior research fellow at the UCL Institute for Sustainable Resources, Katie Kedward, who's my colleague at IIPP, and Frank van Leuven, who's at the New Economics Foundation. The links to both papers are in this slide, and all the slides will be made available to you. The context really here is the fact that central banks and financial supervisors have now essentially accepted that climate change poses a material threat to financial stability and is thus very much part of central banks' mandates. There's been a bit less discussion about environmental related risks, but I think there's an underlying assumption actually that nature-based risks essentially pose the same sort of financial stability challenge, broadly speaking. And the key challenge really here is that while these risks, while the time horizon around these risks is quite uncertain, we don't really know when they're going to happen, we don't know the types, what exactly is going to happen, but we do know that they call for action now, i.e. there's a trade-off between doing nothing and trying to understand them better, and acting now to try and reduce their severity. However, the Network for Greening the Financial System, who many of you may be associated with, has focused very much on this need to build intellectual capacity around understanding these risks, and as they put it in this quote, translate the science into decision useful financial risk assessment information. And the approach that's been taken so far, broadly speaking, has been to encourage private financial institutions, in particular banks, to develop voluntary guidelines for dealing with these risks. So the Task Force on Climate-Related Financial Disclosures. More recently, we've had the creation of the Task Force on Nature-Related Financial Disclosures that some of you may know about. Again, this is very much a private sector-led initiative, although I think there's some regulators sort of getting interested, but it's very much private sector-led. And the tools that have been emerging are very much around stress testing banks and other financial institutions for different types of risks, and the development of scenario-based risk analysis. Now, just to emphasize the point about nature-related risks, this is a report that just came out today, actually, around the risk of ecosystem collapse. It's a report by Swiss Re, the reinsurance company Swiss Re. And what they have found, according to research published, says 1/5 of the world's countries are at risk of ecosystem collapse, and that this would do enormous damage to GDP. And there's a map there showing you the countries at very high risk in red. And there, just in the bottom of that screen, is the Task Force on Nature-Related Financial Disclosures, and some of its members, as you can see, as I mentioned, mainly private sector led. So this is an area that's really active, and I think central banks and financial supervisors are going to be heavily engaged in this in the coming years, even though it's only just sort of kicking off now. Now, the questions I'd like to pose really are, when we talk about intellectual capacity around these financial risks, when do we think we'll have sort of sufficient capacity to actually take action to regulate, to adjust our policy frameworks? What is the purpose actually of scenario modeling and stress testing? Because you can do them, you can gather the information, but then I suppose the question is kind of what happens next? Is the purpose of these activities to send signals to markets, or to just give supervisors more information in order to inform action? It's slightly unclear at the moment, I'd say. Our quantitative results are prerequisite for financial regulation. And there is this time horizon question. So some of these sort of tests, scenarios are very, very long-term type scenarios, and with climate change they need to be. For nature-related risk, actually, one can argue the time frame is rather shorter, but certainly for climate change we need to look a long way ahead, and that poses questions around what does a sensible balance sheet look like, in 2050 as compared to now? Well, of course, it's completely impossible to predict what a bank's balance sheet will look like that far ahead of time, which of course calls into question really whether that type of scenario analysis is very useful or meaningful. And as I mentioned before, not intervening in the current trajectory is also a policy choice, right? Let's not pretend it's not. Delaying action implies escalating costs and escalating risks. I'm sure most of you will agree with that. Those are the sort of questions we're dealing with. I mean, just on the scenario analysis, again, I mean, I do think, I'm not saying scenario analysis is a complete waste of time. I think it can provide useful information. Whether it's decision useful, I think is a sort of another question, really. Maybe it's useful politically to make the political case for financial regulations. But just to show you the challenge here, this is the cumulative fire detections in New South Wales in Australia, the state with Sydney in it, from 2000 up to 2020. And you can see there that, you know, most years, you know, we got up to sort of 10 or 20,000 fire detections. Then you had one sort of outlier in 2002, and maybe you could argue a scenario test would pick up that kind of outlier, but would it have picked up what happened last year or this year? I was actually in Sydney in November and December, and it felt very unpredictable. I can assure you. So that's a sort of that's a classic sort of exponential, non-linear kind of development that I think we need to deal with, and that's just talking about physical risk, right? That's not actually talking about transition risk, and transition risk is also a really important part of the challenge, really, because it creates certain types of endogenous developments which are very, very hard, if not impossible, to foresee. So what is the nature of these risks? Well, we know about the time horizon, we know they're unprecedented, we know there's many of them are essentially irreversible, and as I said, many of them are affected by this endogeneity issue, in the sense that particularly the socioeconomic sort of scenarios you might be looking at, or the political and policy tool uncertainty that you're dealing with, involves, for example, Donald Trump being elected versus another American president, with completely different impacts on policy and politics around climate change from the world's leading economy. So this transition risk creates a huge amount of additional complexity. And then there are the more standard arguments around the financial system itself being highly interconnected, which we learnt about after the financial crisis of 2009, of course. That applies equally to climate risks and systemic. So huge amount of challenges here. And for me, it's clear to me what we're dealing with here is a case of uncertainty, radical uncertainty, in Knightian terms, rather than risk, which is the terms we've been using for the last however many years when describing these challenges. So obviously, uncertainty is an unknown outcome for which there's no realistic estimates that you can make for different probabilities. And typically, financial probabilistic approaches are based on backward-looking data. What's happened in the past? Can we extrapolate probabilities based on that for future occurrences? Now, I think regulators and the NGFS have, to some extent at least, accepted this argument. We can see that in one of their most recent reports in June this year. There are significant gaps in the literature, which means the level of uncertainty is greater than the ranges shown in this section. This is a guide to central banks on scenario analysis. Studies are unable to capture tipping points, feedback effects from physical to transition risks. I mean, everything I've just talked about, essentially. And the integrated assessment models used for the NGFS scenarios do not include these channels. Now, let's just be clear what we're talking about when we talk about tipping points. A tipping point is essentially when you're dealing with either climate change or, in this case, focused on biodiversity. It involves a change in state, a change in the physical and socioeconomic state of the world. And the result of this change in state is, in the case of biodiversity, fewer ecosystem services, supply and demand disruptions, increasing default rates, falling asset prices, for example. This is if, there was a report recently about the Amazon rapidly shifting into a state of essentially savanna, that is a real kind of risk that could happen. There are no historical precedents for these types of events and no scientific certainty really around the nature of this changed state. So these are not things that we can look at previous data to help us determine. Now, I think part of the issue for central banks and supervisors is that they've been thinking about these risks as if they themselves are somehow exogenous to the process. So a bit like a weatherman, you know, the fact that the weatherman tells you the weather the day before you go out may inform whether or not you take an umbrella out the next day. You know, the probability of rain is X. But the fact that the weatherman said that and the fact of whether you take an umbrella or not makes no difference at all to the actual probability of whether it's going to rain. Okay, that type of situation does not apply when it comes to either climate change or environmental, wider environmental financial risks, because central banks and regulators are part of that system that determines the final outcomes. The reason for that is that not only is finance exposed to these kinds of risks, but finance helps create those risks so in a sense, the actions of the regulators help determine how much finance is flowing into deforestation or into extracting fossil fuels, etc. But there's very little analysis of this kind of what's technically termed double materiality in the literature or in policy analysis. You'll see the word double materiality doesn't really appear in many publications issued by central banks. So it's almost as if somehow the risk is exogenous. And we think this is a major issue. And it's also an issue because the underlying sort of market fixing, you might call it, or, you know, what we have here is an externality and we just need to price in that externality and the market will adjust itself, doesn't apply in this situation where actors, including political actors, are part of the endogenous process that determines these outcomes. So we would argue, you know, this, as argued here by Henry Paulson in the Financial Times, is essentially saying if we create an asset class of healthy soils and pollinators, finance will kind of save the day, and doesn't really mention the idea that in fact governments, you know, could just regulate to prevent activities that kill bees or remove forests. There's a slight danger, I think, that we end up believing that this market failure approach will sort of sort everything out, or assetization, as you might call it. So we think a different approach is required. And we've called that approach sort of precautionary policy approach in both the papers I mentioned at the start. It's the same kind of concept. And it's based very much on this precautionary principle that some of you may know from sort of European environmental regulation in particular. It's been around since the late 90s, really, middle 90s. Essentially here, the idea is that decision makers should anticipate harm before it occurs, where there is a credible threat of serious or irreversible damage, even if there is a lack of scientific certainty about the actual nature of those risks, their timing and their severity. There's an insistence on not postponing action, and an insistence in a sense on whoever's doing the activity that may be creating risk to sort of prove that what they're doing is not harmful, as opposed to an emphasis on the regulator to discover how much risk is going to be created before they act. So it's sort of slightly reversing the onus of proof. And those are just two quotes from two of the most famous sort of versions of the precautionary principle. But how does this apply to finance exactly? Well, I think the key lesson should be that supervisors, regulators should be focusing on avoiding the worst case scenario not trying to predict the most plausible ones. So, what is the worst case scenario? How can we prevent that from happening? And if you do that, what you end up doing is focusing very much on these tipping points that we've already talked about. So what are the actions that prevent that biodiversity ball slipping over into this changed state? And clearly building systemic resilience, not just of the financial system by having reducing leverage ratios, but actually by increasing the resilience of the ecosystem. You will, even if you don't know what the risks are, in a sense that the absorptive capacity of the natural world to deal with those risks is reduced. And again, this is this double materiality point. Finance can either support that resilience or it can weaken it. And at the moment, there's a lot of finance that's systemically weakening it, essentially. Now, I think macroprudential policy, in a sense, provides the broad framework for doing these kinds of policies. Their macroprudential policy emerged after 2008 as a set of tools to deal with systemic and endogenous financial risks, focus very much on uncertainty. You don't try and isolate a particular risk for a particular bank, because we know that's impossible to do with any sense of certainty. Rather, you look at the whole economy and you try and reduce, the amount of credit flowing into commercial real estate as a very broad sector, because that sector is systemically dangerous for balance sheets across households and across the whole economy. And you just raise the amount of capital banks have to hold against that type of asset. This is an obvious way forward, to simply apply that type of policy to lending that is damaging either to the climate or to nature, broadly speaking. But the emphasis on preemptive interventions, leaning against the wind, resilience, systemic resilience, and reducing contagion and shock propagation. So, most of you, I'm sure, will be familiar with these basic ideas. And of course, you would focus interventions on mitigation, supporting a decarbonisation of the economy or greater natural world resilience by changing incentive structures, penalising via higher capital requirements, or prohibiting financing or investment in activities that are incompatible, and supporting those that are climate desirable. And then in terms of adaptation, as I said, improving resilience and reinforcing against these types of risks. And I think just on that last point, more capacity to deal with transition risk has got to be a key part of it. At the project level, restrictions on lending, higher capital risk weightings. At the company level, you could have caps on the level of debt financing. And at the sector level, I think we need to be thinking about credit allocation policies that discourage or encourage lending that we used to have actually in the post-war period. But we also need to think about how these would apply to capital markets and shadow banks, because obviously there'd be substitution effects in the modern globalized financial system. And I think there's some evidence of supervisors are moving in this direction. This is the guide for supervisors the NGFS published in May, where it mentions risk mitigation tools, but also mentions limiting or prohibiting financial institutions from carrying out certain categories of activities or underwriting them, etc., in certain sectors. So I guess we're sort of moving in that direction, but I think we need to move a little bit faster. And just to make the point about the importance of environmental risks, we can't really understand climate risks as separate from these environmental risks. They interact with each other, and so you have to, I think about them in the whole. We've obviously got much stronger metrics for climate change than we do for environmental risks, but I don't think that should stop us moving towards regulation in a fairly short space of time. And I'll just leave you with that quote from Luisa Pereira da Silva from the BIS, faced with sets of events that are complex, subject to uncertainty, the likelihood of massive future impact, green swans call less for improvements in risk modelling and more for decisive and immediate action and coordination. Thanks very much.
Thank you very much, Josh. So let me remind to all of you, there are many central bankers in the audience. We would be very interested in knowing your opinion on Josh's points or any question you might have. So you can either ask your questions in the Q&A window that you see at the bottom, or you can raise your hand and I will have to allow you to speak so that you can pose your question directly. So feel free to do that. Let me, however, jump in with a couple of questions, Josh, because I had the opportunity to discuss with you many times about these topics. And let me already ask you something that I feel it's important, which it has to do with the right institutional framework to deal with these issues. So, of course, the precautionary approach and the precautionary principle is something that has been there in the debate for many decades, but now you're applying it to central banks and financial regulators. Why central banks and financial regulators? So why do you think it should be them intervening in this type of issues? And what risks do you see in that? So is there any risk in exceeding with the precautionary approach?
Mm-hmm. Well, I think it's a good question. And the first thing I would say is I certainly do not believe that central banks and supervisors should be the only institutions dealing with these issues. Clearly, governments, ministries of finance, industrial policy also need to be trying to deal with them. And, there haven't been, essentially. But that doesn't mean that central banks should do nothing, I think, just because governments are not taxing or intervening in the way we might like. As economists, we live in the world of second best, and we're in a second best world in this case, without any doubt. I mean, the other key argument, I think, for central banks and supervisors intervening is that they are so macroeconomically important. They remain the lender of last resort to a very large part of the financial system, the majority of the financial system, not just the banking sector, as we have seen with the COVID recovery or lack of recovery. But the COVID bailouts involved central banks supporting non-bank institutions, mutual funds, and various ETFs in the US, exchange traded funds, and basically capital markets more generally. So they have a huge amount of leverage and a huge amount of influence just in what they say, even in terms of what they actually do. And I think one could turn the argument on its head really and say, if central banks and supervisors don't step in, there is a real risk that financial stability risks will worsen at a rapid rate. And in a sense, they would then be essentially not observing their own mandates. So I think even within the mandate, the financial stability mandate, there is a strong case for stepping in. I mean, there are risks, of course, for central banks entering this arena. There will be accusations of, not observing market neutrality or favouring particular sectors and saying, they're not democratic institutions, they're not democratically accountable in the way government is, why should they be stepping in? But I think we're sort of moving past that. I think there was a speech by Isabel Schnabel very recently, essentially challenging this market neutrality thesis from the ECB and saying, where there's clear evidence of financial stability risks, we need to be not too constrained essentially by this approach.
Sorry. Let me give the floor now to a couple of people in the audience. If you don't mind, I would gather a couple of questions so that you can answer them together. So Gabriela Mundaka, I will now allow you to talk. Let's see if this works.
Can you hear me?
Yes, we can hear you. Hello.
Yes.
Hi, Gabriela.
Hi, good morning.
Can you introduce yourself?
Yes, I'm Gabriela Mundaka. I have a question about these financial markets and intermediaries. So do you think they should be starting to have some guidelines of the type of lending that these banks or these intermediaries should have oriented to green economies? And following that, the central bank should say, if you need a liquidity help emergency down the road, possibly we have to check what kind of lending you have given. Because, you know, if you're going to start to continue financing or lending to brown economies, to finance brown investment, right? So that then hopefully not too long, it won't be very profitable. So it is becomes more risky. So perhaps there should be some guidelines on investing in green infrastructure, you know. And then again, the central bank should also have some guidelines of, well, I'm going to provide you some liquidity or some quote unquote help if you need me down the road, if you have some financial stress, if you have done your job. Yes, thank you.
Thank you, Gabriela. Let me also give the floor to Pablo Bortz so that we gather a couple of questions. Pablo,
can you hear me? Hi, can you hear me? Well, thanks for the webinar. My name is Pablo Bortz from Argentina. I have two questions. First, about uncertainty and the response to uncertainty. I wanted to know if Josh could comment on, like, the response to uncertainty is to do something in these cases, like to not do something, to not do anything is a harm. No, perhaps not the proper response to this type of uncertainty that we are facing. And the second question is, what about talking from an emerging market, from an emerging economy? What about the positive policies, the economic, productive, and balance of payment impact of divesting from banks, divesting from the sectors to which they traditionally lend? For instance, in Argentina, one of the main polluters is the agricultural sector, which provides most of our foreign exchange. So how can we integrate that into the precautionary principle? Because divesting from these sectors might reduce the exports, might reduce supply of foreign currency, and threaten financial stability. How should we deal with these other issues? That's it.
Josh.
Okay, great questions. Thanks, thanks, Pablo. Just coming to the first question there, I think that was a question about sort of green credit allocation, which I sort of mentioned at the end of my presentation quite quickly. But essentially, yes, I would argue that central bank should be looking at providing some form of credit guidance, whether that's the type of restrictions on, for example, the sort of capital requirements that they have to hold against certain types of assets, as I mentioned earlier, or you know, loan to value ratios that they would have to hold. They would have a limit on the amount of debt relative to the value of their own company. Essentially, these types, you know, lending to fossil fuels, for example, or that supports deforestation, you know, that needs to be seen as directly supporting financial instability, and appropriate penalties need to be applied to it. Now, the encouraging more lending into greener sectors, I think, is in a sense slightly more challenging from a regulatory perspective, because it's rather hard to know, in 10 years' time, which sectors or which innovations, for example, will prove themselves to be successful. So broadly speaking, I'm sort of more confident in saying, restrict lending to the XX and X sectors that clearly are unsustainable, where there's no sort of doubt these sectors are problematic. Unfortunately, the direction of policy seems to have been, for example, with the EU taxonomy, seems to have been more towards a sort of green taxonomy rather than a brown taxonomy. Now, the reasons for that, one can speculate, might be to do with lobbying of certain interests. But I think broadly that's the wrong approach. And actually, I think most central banks would agree on that point, that it's easier to identify the most unsustainable forms of activity than it is to identify those that will be most successful. Coming to Pablo's question, I wasn't quite sure about your first question, but I think it was about that maybe there's a tension between the precautionary principle, which essentially, under a situation of certainty, stops, say, a new drug or a new environmental, chemical, environmentally potentially damaging chemical being created and used, that the onus is on the producer to prove to the authorities they can't do that. And what I'm suggesting, which is slightly different, because what I'm suggesting is central banks should identify activities that are unsustainable and prohibit further lending or investment against those. I appreciate that tension, but I think, and that's why we haven't just called it a precautionary principle for financial regulators, because there's a difference between those two types of intervention. But I still think one can use the precautionary kind of principle framework fundamentally, that under conditions of uncertainty, where there is a risk of irreversible damage and harm, the onus should be to act rather than just try and find out more information before acting. I think your point about the risk for emerging market economies from divesting in certain kinds of unsustainable activities is a really good question. I don't have an easy answer to that one, other than I think all economies, including emerging markets, do need to start looking about how to domestically transition to more sustainable modes of production. Of course, the demand for those goods often comes from advanced economies, and I think we need to be thinking about reducing that demand, which would help enable that transition and make it politically more easy. So, importing, the UK imports loads of soy from Brazil. How do we reduce that demand? And I think there's an onus on advanced economies to move much faster than emerging or developing market economies in this space, and to set an example, really, because obviously, we've been setting the terms of the global trade system for the last however many years.
Thank you, Josh. If that's okay for you, I would gather now 3 questions that appeared in the Q&A and in the chat, and that should bring us to 6:45, so to let you go. So let me read them. So the first one is from Andrei Yuravlyov, apologies for the pronunciation, which actually asks a much deeper question than the time that we have available, which is, if green agenda is not strong in a nation and financial institutions are struggling with low interest rates and growing burden of regulation after the crisis, can and should a central bank and other financial regulators initiate this new type of regulation and supervision, which I guess it's pointing to the fact that additional supervision, additional regulation might actually exacerbate an environment which is already quite stressful for financial institutions. Christian Metzler is asking something about data. what would be the guidelines for environmental data companies should report on. That is decision useful for investors, but provides enough information for macroprudential regulation and policy goals at the same time. In the latter, so to provide information for macroprudential regulation, it is rather aggregate macro information that is relevant. For instance, extinction of a certain species, desertification, degradation of land. Would it make sense to ask companies to provide the relevant data for the latter use? And finally, there is a question from Giovanna Ottaviani Almo from the Norwegian Institute of Bioeconomy Research, asking, isn't this one of the expected outcomes of the Green Deal to introduce measures facilitating green credit? So maybe I can interpret this question as, aren't we already going towards the precautionary approach as we are?
Yeah, great. Okay. So the first question, is now a bad time to be imposing these type of regulations? I mean, yes, it probably is. But it's also, in a sense, a good time, I would argue, because this is essentially the worst, well, certainly the worst sort of financial, worst economic crisis we've faced probably since the war. I think it will be worse than 2008, 2009 in terms of impact on industries, possibly not on banks. You could argue banks haven't done too badly, mainly because central banks have played a much more active role. So in that sense, a lot of things are up in the air. Okay, so we've seen fiscal policymakers doing things that are completely unimaginable, just last year, taking on huge amounts of debt. Essentially, central banks have essentially monetized a lot of that debt, implicitly. So, I think in a sense it is a bad time maybe for some banks, but it's also a good time to be taking action. And of course, COVID itself, was a nature-related financial risk. So the cause was essentially zoonotic disease transfer between animals and humans, caused at least in part by expansion into rainforests or wherever it may be, and by the animal trade. So financing of those activities needs to stop, I think. The data question, I think that's a really interesting question, which I will be thinking about going forward as we continue with this research. I think you're right that maybe it's better to look at aggregate measures and not to worry too much about forcing, say, individual banks to be reporting on exactly the types of loans that they're making. Again, unfortunately, I think that the TNFD, the Task Force on Nature-Related Financial Disclosures, is probably going down that path. Again, just like the TCFD before it, as if individual market actors can themselves work out how they should report, what the nature of the risks are. I just don't believe that's feasible, and we do need more macro-focused regulation. That's why I talked about macroprudential regulation rather than microprudential regulation in this space. Green Deal, the Green Deal, Green New Deal, whatever you want to call it, hopefully will take us down the path I've been talking about. But I think it's much more, the Green Deal is going to be much more about encouraging more credit into those sectors where we need it, rather than restricting credit to environmentally unsustainable sectors. I think that is a job of financial regulators and central banks, not necessarily of governments. Historically, that's been their job, to reduce financial stability risk. So I think the two can work together effectively. Thanks very much.
Thank you, Josh. So there is another couple of questions by Andre and Simona Costanzo. What I maybe would like to ask to EX's organizers is to then forward these questions to Josh so that he can answer later. Let me just, before closing the event, remind you that in 2 weeks, we have another webinar where the speaker will be Uli Volz, who is at the SOAS, Center for Sustainable Finance. And the webinar will be about climate change and sovereign risk. Him and his co-authors had a report coming out today on this topic, so it should be fun. And I will see you all in 2 weeks. And Josh, thank you very much again for joining us.
Thank you. Thank you very much. Bye-bye.
Cheers.